to have a more value bias, but I'm investing in the junior resource space. Some people say that might be a very incoherent view because these are speculative, very volatile stocks that don't generate cash flow. Like I don't think Warren Buffett would ever invest in a junior mining stock, right? It doesn't have the attributes of cash flow and high quality that he would look for. But having an institutional mindset with real rigor to this space is something that not many people bring. And I think that's the advantage. And at that point in time, the stock does well. I'm hoping to make 10, 20, 30, 50 times the money off that base. So if you look at my portfolio today, I might have 4 to 5 names that are well above 10% of my total capital. But it's a combination of subsequent investments from my cost basis and price appreciation.
Michael Gentile, co-founder of Bastion Asset Management, as well as strategic investor in the junior mining sector. It is a true pleasure to host you on Palisade's Gold Radio today.
Great to be on the platform, Stijn.
Excellent. Really excited to start talking about precious metals and really what you are looking for and how you are positioning yourself as we speak. But before we do that, I would love to get started talking about you, Michael, and how and when you got started in the commodities industry.
Yeah, it's amazing the impact that a teacher can have on a young person's life. So both my parents are teachers. I was 10 years old in grade 4 in elementary school, and one of my teachers did a project on the stock market. We didn't have computers back then, or just starting to have computers, so everything was by hand. But we looked at companies like IBM and McDonald's. My dad had an IBM computer. He used to go to McDonald's with my dad once in a while for breakfast or lunch. And so we followed companies that we knew about as young children, and it really fascinated me. The stock market captivated me at 10 years old. So I always knew I wanted to be involved in the stock market from a very young age. Studied finance in university. Read lots of books on Warren Buffett and Peter Lynch, different classic books I read very early in my life. And I realized I wanted to get involved in the most inefficient corners of the market. So I really was gravitating towards small cap stocks and not the more mainstream covered larger names. I ended up getting a job in Montreal at a small mid cap boutique, kind of my dream setup. We covered North American stocks, Canada, US, for about 300 million to about 10 billion. I worked at that firm for about 18 years. And the first sector I covered actually was commodities. So that's really my first love, and maintained my love affair with commodities since that young age. It was actually way back in university. I was in a program where we managed $1 million of live money in university, and it was during the tech boom. I'll never forget this. From 1999, 2000, we had 8 portfolio managers. We had a first meeting with all the portfolio management team to decide on who would cover what in terms of which sectors. Every single person wanted to cover technology except me. So all the hands went up for tech. And when we got around to energy and commodities, there was absolutely zero interest because the sector was very much out of favor. And I said, I'll cover anything. I didn't really know much about commodities. I ended up covering oil and gas back then. And as you recall, oil was around $10 a barrel. Everyone was saying it was going to $5. The biggest magazine in Canada had said it's the end of oil, was the headline of the magazine, which is usually a good sign it's not the end of something. So instead of going from 5, oil went from 10 to 145. So it was my first lesson in counter-cyclical commodity investing and buy when there's negativity in the sector. And that just led me deeper and deeper into commodities. From that, I covered all the other base metals, gold, just pretty much stayed in that lane, covering commodities professionally for many, many years.
Awesome. Thanks for that overview, Michael. And that's quite a journey there from quite humble beginnings to now being a strategic investor, taking large stakes in these junior mining companies like you're doing now. What would you really say is your main competitive advantage, or really your niche that allowed you to really have that journey through all the ranks?
Yeah, so I had, like I said, an 18-year institutional background. I worked institutionally from 2001 to 2018, covering mainly producers, so companies that had cash flow, that were producing mines. So when I took some time off for my family reasons in 2018 and had some capital and was thinking about where I wanted to invest, the gold price was around $1,350 and very, very negative. We come out of an 8-year bear market. I started investing in gold in 2015 for my institutional investors when gold was $1,100 an ounce. There's just extreme negativity there. And I had a very strong view, we can talk about macro views later, but a very strong view that the next 10, 20 years would be very, very bullish for gold. So I asked myself, what is the sector, part of the gold market, that's going to do the best if I'm right about my gold price rising? And typically, you get the most leverage in the smaller, micro cap resource names, junior sector. And professionally, in my old job, I was not allowed to invest in those names. We really had a 200 million or above market cap criteria. We wanted to see cash flow and existing production. So when I had that view that gold was going to do very well and I wanted to maximize my exposure with my own capital, I started investing in the junior resource sector. And because I had not done a lot of microcap resource investing prior to that, I tried to take the framework of what does a producing mine look like? what are the attributes of a producing mine? What were the cash flowing stories I was owning for decades at my old firm? And overlay that on the junior resource sector. So even though it was only a $10 million market cap, even though you may not have all those answers to the questions yet, really asking myself, does this company have the attributes to become a mine one day? And superimposing that. And going back to my roots of looking for inefficient corners of the market, hard to find a more inefficient, poorly followed sector than junior resource sector. Because there is no institutional money, there's very limited coverage from the institutional firms that go in that space, mainly retail money. It's mainly driven by sentiment and emotion, and not so much by rigorous analysis. And so there was a lot of inefficiency in that market. So the more I looked under the hood, the more I saw that I could add a tremendous amount of value, understanding how successful mines were built, superimposing on the junior mining sector, finding a very inefficient sector that was poorly covered, and also at a time where the sector was very negative and sentiment was very, very low, provided a tremendous amount of opportunity, which really got me more and more engaged in that space. And one investment became 2, became 5, to the point where today I've the leading shareholder of about 25 to 30 junior mining companies, just because the opportunities were so compelling, I couldn't stop myself.
Couldn't stop yourself, all right. And I completely understand that take of being willing to be contrarian, taking a bet that other people are not willing to take, looking at other sectors that other people are not willing to look at. How much do you think your willingness to take a long-term bet plays into that success as well, compared to a lot of people that are focused on short-term trading nowadays?
That's a really great question, Stijn. So because I was reverse engineering what a mine would look like in 5 to 10 years, and because when I made my initial investment, I wasn't trying to make 10 or 20%. My idea was, if I'm right on some of these stocks, I want to make 20, 30, 50 times my money. So you have to take a long-term approach if you want to take that kind of money. And early on in my career, investing in oil and gas, I was fortunate enough to have some stocks that went up 20, 30, 40, 50 times. So I knew what it felt like. I knew we had to hang on to these stocks. They don't go up 50 times in 6 months or 1 quarter. Like many investors these days, they want to buy stock on Monday and they're yelling and screaming at their keyboards if it's not up by Friday, right? So you have to have a bit of a longer term approach. And these mining business, especially the junior mining business, it takes time to de-risk these assets, right? It takes time to drill out the resource, do the technical studies, get the social license, the government permissions, the infrastructure in place. So when I make an initial investment, Stijn, I'm looking for at least a 3 to 10 year horizon, more likely a 5 to 10 year horizon when I make an investment. So that's my outlook. And having that patient, long-term approach, I think allows me to make better decisions than those that are reacting to price. So if the stock market's down, a sector is down, they're negative, or reacting to news, drill results or assays or lack of news sometimes in these companies, right? So I do take a very long-term, I take a private equity kind of venture capital approach to investing in the junior resource sector. I make very large investments. I'll buy anywhere from 5 to 20% of the company on my initial investment, which, whether I want a long-term approach or not, that size investment precludes me from really trading around it, because most of these stocks are quite illiquid, especially early on when you're making an initial investment. So it kind of handcuffs me to the stories. I do a lot of work up front to de-risk my investment. I'll look at 20, 30, 50 investments for every one that I say yes to. So I'm trying to reduce my risk by doing very thorough looking at the opportunities in the market relative to each other and relative to the actual fundamentals of the story. And so, yeah, that long-term approach really serves me well. And I look less at stock market price of the stock versus, is the company executing to plan? When I make an investment, I lay out a scenario, 3 to 5 years from now, the company could look like this if they execute on what I think is possible. And I'm always measuring the stock price versus that, in terms of if they're continuing to execute well and they're progressing even faster than I hoped, and the stock is not moving or the stock is down, I'm actually likely adding on the next private placement or adding in the open market. If the stock price is up and yet they're not executing well, I'm definitely not adding and potentially selling the stock because they're not executing to my plan. So I'm less a slave to the price action and more focused on, are they executing to where I believe they could get to? And what does that mean in terms of value implications for the story when it gets to those thresholds of value?
This episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Yeah, really interesting perspective in the commodity space. It sounds like those influences early on, the Warren Buffetts, the Charlie Mungerts, and the Peter Lynch's are really flowing through into your investment thesis, into your investment style now.
It's an interesting point you bring up. So I consider myself a value investor, like a value investor. I have a more value bias, but I'm investing in the junior resource space. Some people say that might be a very incoherent view because these are speculative, very volatile stocks that don't generate cash flow. Like I don't think Warren Buffett would ever invest in a junior mining stock, right? It doesn't have the attributes of cash flow and high quality that he would look for. But having an institutional mindset with real rigor to this space is something that not many people bring, and I think that's the advantage, right? It's fishing in a pond with a better fishing pole, a pond full of fish that no one knows how to catch. That's sort of the advantage that I brought, and yeah, having a quality mindset in the junior space doesn't mean they have cash flow, but it means they have attributes of quality companies that will succeed more likely than not versus their peer group. That's sort of the rigor I've tried to bring in, and adopting some of that thinking in a space that's not exactly parallel to what those investors typically invest in.
Awesome. Thank you for taking along there, Michael. Really interesting to hear that background and really from what perspective you've developed your thesis and the roadmap to how you got here. I would love to start talking about some of the commodity cycles that you've met along the way in your journey thus far. Perhaps you can take us along what some of the big lessons are and what some of the big cycles are that have really had a big influence on that roadmap.
Yeah, I'll take you back to the very beginning, the first cycle I witnessed, which was the oil and gas cycle. That was in the late 90s. And it's interesting, Stijn. It has a lot of parallels to today. I mean, the history doesn't repeat, but it rhymes, I often say. And so what I've seen in the oil and gas cycle in the late 90s was the market was, as you may recall, completely fixated on the dot-com boom. Like if you weren't a dot-com stock and you weren't tied to the internet, you really had no value. They called every other stock old economy stocks. So there's new economy stocks and old economy stocks. So if you're a railroad, a distributor, a bank, you had very little interest in your stocks. People were only wanting to own dot-com stocks. But at the same time, under the hood, there was this mega trend of the emergence of China as China's economy was going from rural to a city-based economy, massive investments in infrastructure. There was a huge demand for commodities. But for many years, even despite that tailwind that was starting to become clear in the late 90s, investors were so fixated on the dot-com boom, they were ignoring it, and they were actually quite pessimistic on oil. And so the stocks were cheap. Not only was oil $10 a barrel, but the stocks were trading at values below $10 a barrel. People believed that $10 a barrel was too high. And so I had this emerging view that oil demand was going to go up. The market was ignoring it completely, and the supply was very constrained due to the prices were being low, so there's no new supply being added in a meaningful way in the industry. So that was my first lesson on, when people are distracted, there's negativity, there's a real strong macro thesis for a sector. That to me is the best combination to buy a commodity. When I see a positive outlook for macro demand of a commodity and the market is negative, that is the best combination to find value. And you have to ask yourself, well, why is that the case, right? When you're arguing with the market, quite often you're wrong because the market's not stupid. Most of the time the market is right on its assessment. So if I'm arguing in that case, it was really the dot-com boom that was taking all the energy, all the air out of the market. There was no room for really thought around anything else but dot-com stocks. So that was the first lesson. We can fast forward to the day later, which I think AI is a very similar trend. That's obviously a mega trend, but it's distracting people from other mega trends that are happening in the market, both in terms of the needs of commodities and the macro role of gold in the global economy. So that was the first one. My first trip with gold was in the early 2000s. The central banks were systematically selling their gold. I mean, Canada sold all their gold at that point in time. Canada has no longer any more gold in the central bank balance sheet. And again, had a view that gold would maintain, in the long term, its role in the monetary system. And there was just extreme negativity. So I started buying gold stocks in the early 2000s, and that led into the mega rally we saw, going from 2008 to 2012, culminating in that rally. But again, the thesis of everyone's negative, the central banks are selling, everyone is selling, and I had a view that gold would still have a role to play in the monetary system. And so therefore it was a really good time to buy. But it was a longer period. That took a lot longer to play out. But again, the values were there. Being a long-term patient investor didn't bother me. The stocks didn't go up the next day, but I thought the macro thesis was pretty intact. So those are kind of the two early cycles. And then I've dabbled in different cycles like copper and gold again in the 90s, oil and gas from 2008 to 2014, coming back to different outlooks where we had the shale boom which was a real revolution of the industry in terms of supply. So it was positive at first and then turned quickly negative when the supply increases. But just having that viewpoint of where do I disagree with the market? Where do I have because I'm a long-term investor, I've got to have a longer-term view. To give you an example, lithium had a little super powerful move, 2-3 year move a few years ago. I didn't feel that rally had legs, because when I looked at the supply demand outlook for lithium, I realized that lithium was not geologically scarce. And so while there was a huge surge in demand causing prices to spike, I felt that the supply would be able to catch up much quicker than investors believed. And any wobble in that demand outlook would cause a massive drop. So I didn't do any lithium meetings. I refused to invest in the sector. I missed out on a heck of an 18-month run. But because my horizon is 3 to 10 years, I felt I didn't have enough time to deploy the capital. I didn't believe in the durability of the cycle, and therefore I just stayed on the sidelines during that cycle. So I really need to see a mega trend. Like we had oil in the 90s, we have gold currently from 2015 to today, where I see 10, 20-year outlook for sustained rising prices, combined with the opportunity to buy stocks at very low levels due to pessimism.
Yeah, some great points there, Michael. The market is definitely not stupid. Directionally, it is almost always right, but intensity-wise, it can be wrong. Like you outlined in the dot-com bubble, internet has changed the world. I mean, even this meeting wouldn't be possible without the internet as a facility. Although those valuations back then were a bit, elated, let's say.
Yeah, it's a great. I mean, the internet ended up being even bigger than the most wide-eyed bull dreamed of in the late 90s. We remember like making fun of some of them, how they were like, the internet's going to be just massive and it's going to change the world. And the internet ended up being even larger than that. But just for your younger viewers, just to remind them, the NASDAQ went down 80% from peak to trough, even though the internet ended up being much larger than people thought. So just as a warning for those people that are all in on AI, I think AI is going to have a similar impact on the world the internet did 20 years ago. That doesn't mean that every AI stock you're buying today is going to be a great investment. In fact, most of the internet.com stocks in the 90s went to zero. You had a few winners, and most of the stocks ended up being terrible investments. Not dissimilar to the junior mining resource sector, right, which most people don't want to spend time on. So that distribution of returns will be something investors have to pay attention to. And don't be surprised if at some point in time the NASDAQ has a 30 to 50% pullback, despite AI being this unstoppable force that people are really believing in. And another thing I'll say too is, bringing my commodity lens to the internet and the .com, the tech stocks, whenever you have a sector, like when the commodity sector is receiving massive amounts of capital, right? When too much capital is chasing a finite idea, that's when returns are typically very low. So why do I like investing in commodities when there's sentiment is low? Is because there's no capital available. So in any investing sector, whether it be tech or commodities or healthcare, if there's no capital available to the companies trying to grow and innovate in that space, the future returns are going to be much higher, because that no capital means you're buying things at much lower valuations. And that no capital means there's not a lot of money to add supply or innovate. All that money pouring into AI, just from a macro perspective, just tells me the long-term returns of AI for overall the whole sector are probably going to be lower and disappointing versus what people are expecting, because there's just too much capital chasing even AI being a big idea, a finite idea. So using commodity lessons to look at other sectors is very valuable. And that idea of capital versus return is something that people don't really look at very often, but it is typically a very good precursor of future returns.
Very interesting argument there. And continuing to talk about cycles right now, the cycle that we're in right now, or really what stage of the cycle are we in according to your opinion, Michael?
Yeah, so coming back to that lens of capital available, this cycle has been remarkable to me, Stijn, in terms of I've never seen a commodity cycle like this in the gold space. So where you have the gold price more than doubling in price, making new highs consistently for a couple of years now, and having a pretty robust gold price for several years, and the stock's not responding. Usually when you see commodities making all-time highs, I've lived through oil and gas and other sectors as well in the past, you have this euphoria, you have this generalist interest in the sector, stocks making new all-time highs. It's on CNBC, they're tracking every move, every tick in the oil price. We have not seen that in gold at all. It's been very quiet, kind of stealth, apathetic rally even. There's many stocks, especially in the junior resource sector, are still not back to their highs during COVID when gold was $2,000 an ounce. So there's just been an apathy. And going back to my capital argument, up until about 2-3 months ago, there's been still zero capital available for any company below $100 million market cap. So there's been really a lack of generalist interest and capital available. We're starting to see that change, but this has been 2-3 years of really strong gold price movement and very little capital available. So I would say, based on what I'm seeing in terms of capital availability, generalist interest, mainline investor, retail interest, I think we're still in the second or third inning. And I do believe that this gold rally is sustainable. I'm not here saying it's going to $10,000 tomorrow, but I think the fundamental drivers that have been driving this gold price are as healthy as I've ever seen them. It's physical central bank demand. It's diversification away from the US dollar. It's not a bunch of hedge funds and macro traders saying gold's my trade of the week. And that's what's happened in the past. They're driving the gold price higher. Has been thematic pockets of money chasing gold. This is sticky, stable, long-term asset allocation money on the part of the biggest allocators of the world, which are central banks, versus the faster money's been there in the past. And to me, the faster money has not yet come into the sector. The generalist money is just starting to come into the sector. And you have a better pulse than I do with this, but the generalist interest, the retail interest is still, to me, very, very early. We don't see Uber drivers or taxi drivers talking about gold stocks in their cars. So we're still fixated on AI. We're still fixated on the NASDAQ. We're not focusing on the real powerful rallies happening in the gold and commodity sector, which to me is very, very positive. We still have, in my view, quite a bit of room to run. Like I said, don't be surprised if you have a 10, 20% correction. It's normal on a rising multi-year bull market, but it doesn't feel like it's overbaked or overdone to me by any stretch of the imagination.
Interesting point there. AI and crypto definitely seem to be taking the headlines for now. Agree with that on the retail side. Talking about historical parallels for the sector that we're in right now. If I understand you correctly, there's not really a parallel within your career. Do we then have to look back further, perhaps the 1970s or the 1940s, to really draw on a parallel from which we can learn lessons on really how to trade and then make money on this cycle?
That's a great point. Yeah, trying to be a student of history, I'd say that the best parallel would be the 1970s, I think. I think we're entering a period, and I think the gold price is trying to tell you that. I think the long-term bond yields are telling you that as well, Stijn. We're entering a period of pending negative real rates. You look at the inflation data. I always say inflation, they say it's 3%, but if you actually look at the inflation of stuff you need to buy or you want to buy, like food and shelter and things that are really important to you, it's much, much higher. All your viewers know this when they look at their grocery bills or their cost of living from now versus 5 years ago. Inflation has been much, much hotter than the CPI is advertised. So I think we're in a period of monetary devaluation. I think we're in a period that governments have no choice. With the debt loads that the G7 countries have, they have no choice but to devalue their currencies and create negative real rates or real inflation in the economy. And so the gold price is telling you that. The bond yields, we had rate cuts last week from the Central Bank of Canada and the Federal Reserve in the US, and the 30-year, 10-year bond yields pushed higher. And so the market is telling you, you can suppress lower, shorter-term rates, but we don't want to lend you money at 4 or 5% over 30 years because we know you're going to pay us back in dollars that are worth a lot less. So I think we're going to enter a period where money is slowly or rapidly losing its value relative to hard assets, things that you need to own. And the 70s were a really good, proxy for that, where we had massive inflation. Whether we see massive inflation or not, like in terms of CPI numbers, is one thing. But I think the gold price is telling you, things are getting more expensive every single day, and there's not really an easy way out of this tunnel. I've been saying that since 2018 when I started speaking publicly. The math is getting harder and harder and harder for the U.S. and Japan and Europe to climb out of their debt loads. And at some point, which we're getting very close to, the math is just impossible to overcome. The interest on the debt versus the nominal amount of debt, and what you have to generate as an economy to cover your interest costs, that will not allow interest rates to flow to the level that are necessary to have a balanced market. And therefore, you're going to need the Federal Reserve to come in. I always use the analogy, if you want me to buy a 30-year bond, I'm just an investor. I've allocated capital across all sectors. I'm not unidimensionally focused on commodities. I need like an 8 to 10% yield on a 30-year bond. What I see right now to deploy my capital. I know other investors would want lower yields, but for me to deploy capital, that's the kind of yield I would require, given the risks that I see from the US paying me back in money that's actually worth something 30 years from now. And so if you have that kind of dynamic where new pockets of money are requiring higher yields to lend to the US government, you have the traditional buyers, which are the foreign central banks, the big BRIC countries, right? Used to be massive net buyers of treasuries, are now net sellers of treasuries. So if you're issuing $2 trillion a year of deficits, that's bond funding, got to fund the bond market. Your net buyers of treasuries used to buy $500 billion or $1 trillion of new treasuries per year are now net sellers. You've got to add the amount they're selling on top of that $2 trillion issued per year, and you got to find new buyers for that. And I'm here telling you I'm a new potential buyer. I want much higher yields. So what's your solution as a government? Well, either you let yields rise to clear the market, or you do yield curve control, where the Federal Reserve buys bonds, or you cut rates. Maybe you shouldn't be cutting rates right now, because you need to try to artificially suppress yields to entice buyers to move out the curve, the longer term curve, to take those higher yields for the higher risk that comes with it. So that's the world we're in right now, right? Either you let rates float to the price where the market will clear, and that'll cause massive issues for the fiscal stability of the G7 countries, or you suppress yields. And if you're doing that, the gold price is going to do extremely well because people will be seeking money that can hold value versus artificially suppressing yields, which will depress the value of the currency. So I've been seeing this coming for years. Now that's happening in real time. It's not surprising to me. What surprised me is the velocity at which the debt accumulated, and also now the velocity at which the central banks are repositioning themselves based on these signs they're seeing in the debt market and the fiscal stability of these countries.
The math doesn't work like you outlined, and that's perhaps the one thing that's not really rhyming with this 1970s parallel. The government debts back then were significantly lower than now, which could add another afterburner to this gold bull market then.
Correct. I think the stakes are even higher. I mean, in the 70s, they had a chance by raising rates. And in the 70s, they chose the second option I talked about, right? Letting rates go to 8-10%, where my capital would now be potentially allocated to treasuries. The difference between the 70s and today is that they had a choice in the 70s. I don't think they have a choice now. If you let rates go to 10%, let's just play a little fun with numbers. You let rates go to 10% on the 30-year bond yield, and you have 38 trillion of debt. That's 3.8 trillion a year of interest expense. The government takes in about $6-7 trillion a year of revenue. So you're talking about more than 50-60% of your annual budget, just the interest cost on the debt. I mean, if you were a company, you'd be insolvent. You'd be in Chapter 11 if that happened, right? So that's the math that's becoming impossibly difficult. We spoke previously in a previous interview, so we talked about, Elon Musk was kind of like the last hope, where I said, okay, maybe one of the smartest guys in the world can find a way to cut expenses and get the government to be more efficient and leaner. There was maybe a small window where if you took extreme measures, where I'm talking about austerity, I'm talking about massive investments in technology, and talking about cutting all unnecessary spending in the government, coupled with a pro-growth agenda, maybe you could skid through that small door. I mean, Elon Musk tried for a few months, cut a couple $100 billion of expenses, and then threw his hands up in disgust, saying it's too hard or whatever the reason why he left. At the same time, the government's promoting, pro-growth agendas, which in theory are good, but are also massively inflationary for the deficits. So you've just tacked on another $2 trillion every single year. It almost becomes mathematically impossible to deal with that through cutting spending and austerity and productivity gains. So the only way to do it really is to manage rates lower, because letting rates go to where they otherwise would go naturally would result in a massive recession, maybe depression-like scenario in the U.S., which would just cause even more pain than the first scenario.
Yeah, really interesting. Of course, huge tailwinds for precious metals, for gold and silver, to have this monetary and fiscal spending. And then also included being overlooked as a commodity sector. That's definitely a very interesting case for a potential investment. But if I understand it correctly, that would be the same case for almost all hard assets like copper, oil and gas. Those assets could have the same tailwinds going for them.
Yes, I think what copper and oil and gas and a few of the more economically sensitive commodities don't have going for them is their role in the monetary system. So, I'm always a little bit more cautious with, copper. I do quite like copper. I think there's a real 10-year, 20-year mega trend there in terms of electrification and just demand that's coming for copper. It reminds me of the 90s that we saw in oil and gas. Right, we're pivoting our economy so that even the AI boom, the data center boom, we're going to need more and more power generation. So copper will be a net beneficiary of that. But the day-to-day demand for copper, like the base load demand of copper beyond the surge we're seeing for AI and electrification, is how's the economy doing? They call copper Dr. Copper for a reason, right? So if you have a more muted or risk-averse view of the economy in the next couple of years, copper will have more sensitivity to the economy than, say, gold would have. Oil, similar setup where, it's a hard asset. Oil has never been cheaper versus gold. If you view gold as a real money, like a real proxy for what things cost, gold to oil has never been more attractive. Oil is very, very cheap relative to gold. It remains an essential commodity. What oil is struggling with right now is for the next couple of years, there's a bit of a supply glut as OPEC tries to increase production as much as they can. And there's an overabundance of supply still trying to chewing through the market. I think oil has to have a couple of years of chewing through that supply. But on the other side of that, oil looks quite attractive, especially relative to the consensus, which is extremely negative on oil, which I'm always keeping my eye on. So gold has the benefit of being a hard asset, but also seeing sustained demand from diversification away from treasuries into gold. So as the dollar gets devalued, oil, copper, all those commodities will rise just because paper is worth less. But gold has also benefited from the double tailwind of people actually being net buyers of it to diversify away from that paper money. So that's why I've been positioning the majority of my portfolio in gold, secondarily copper, and keeping a keen eye on oil, waiting for that next opportunity, a window opportunity to deploy some significant capital in that sector as well.
Perfect. Thank you, Michael. And as I promised to the viewers earlier, I would love to start talking really how you are positioning yourself as we speak right now. If I understand correctly, with your fund, Bastion Asset Management, you really look at the producers, the mid cap and the large caps in the gold space. And then with your personal portfolio, you really look at the juniors. Is that right?
Yeah, just to clarify, Bastion Asset Management is run by my partner, Charles Hager. He's the lead portfolio manager, chief investment officer there. It's a generalist fund. So I get lots of emails saying, can I invest in your gold fund? I don't have a gold fund. Bastion Asset Management is what I've done for the vast majority of my career, which is, long, short, hedge fund, concentrated investing in all sectors. But for the last 3.5 years since we started Bastion, my partner Charles, as the lead manager there, has had a bullish view on gold. So we have a significant allocation to gold, but it's just one sector amongst many in our fund. But you're right, in that fund, my job is to cover commodities for Bastion Asset Management. And so we have basically an almost only producer policy in the fund. We do invest in some later stage, close to producing assets, but in general, the fund has that value approach, which you want to see cash flow, buybacks, dividends, really strong, profitable businesses that have really good attributes. And the gold sector has some excellent attributes right now in terms of profitability and free cash flow generation. So that's what's attracted Charles, along with the fact that the macro outlook looks sustainable and intact for a while. So yeah, in that fund, mainly producers. And then whenever you see my name tied to a junior, that's my own capital. And that would be my typical first investment would be between, 10 and $30 million Canadian market cap. Those companies are much too small. Bastion's about 600 million of assets under management. So our customers want us to buy more established, less risky producing names. So with my own capital, I invest in the kind of the wild west of junior exploration and early stage investing. And then Bastion will buy the companies that are, single asset producers. We're not buying Barrick or Newmont. Let's say we're buying single asset producers like K92 Mining or, Asante Gold, some names like that are emerging producers that have potential to have really compelling free cash flow yields and multiple expansion. So I'm able to cover from a microcap explorer all the way to the producers. It gives me a real good breadth of understanding where the market's trading. You can't have junior mining stocks doing well if the producers aren't trading well. And so we're finally seeing the producers start to do well, which is providing a nice umbrella or halo effect for the juniors to have higher valuations. So it's very important to understand the whole picture. And that's what I'm able to do, wearing those two hats on a weekly basis.
Yeah, awesome. And talking about that personal portfolio, really those strategic investments that you make, from a portfolio management perspective, is there an allocation policy based on commodities, or really how do you determine allocation within that portfolio?
In my personal portfolio?
Yeah.
Yeah, I would say it's more a venture capital approach. So yeah, there is a commodity overlay, but it's more just my view of what the opportunities are from a valuation perspective. And like I said earlier, what's my view versus the market? Where's sentiment versus my own in-house view? But what I do in my venture capital junior mining portfolio, I'm very systematic about allocating capital. So initial investment that I make will be about 1% of my available capital to put behind a company. And so I do that, and I'm looking to make a 5 to 20% ownership of a company. That's why I'm fixated on that kind of $5 to $30 million market cap. Usually it's a $1 million check, $1.5 million check, let's say. What I do then is I say, well, it has all the attributes to become a producing company, I hope, even though it's very, very early. And a lot of them will not. So I'll make mistakes for sure. But as they progress along the plan that I've laid out for them, and I see potentially possibly happening, if they're executing well, I'll add on subsequent private placements. So that 1% of capital hopefully will increase with price appreciation. Sometimes not, because you're in a bear market, the stock will not go up. But if they're executing well, I'll participate in subsequent private placements, getting myself anywhere to about 3 to 5% of my committed capital on a cost basis behind that company. And then at that point in time, if I've done 3 to 5 private placements, they're probably moving along quite nicely over the execution steps that I've laid out for them. And at that point in time, the stock does well. I'm hoping to make 10, 20, 30, 50 times my money off that base. So if you look at my portfolio today, I might have 4 to 5 names that are well above 10% of my total capital. But it's a combination of subsequent investments from my cost basis and price appreciation. And then I have a bunch of new trees or new seeds that I'm planting in the garden that are new, 1% investments. So it all sums up to a portfolio of 25 to 30 names. I'm constantly adding, new 1% of my capital positions to the portfolio, and I'm adding capital to the ones that are working well. And when the ones that work very, very well, I'll typically either join the board or get very, very involved in the company because it becomes a significant portion of my net worth. And I want to steward that investment for myself and the other shareholders and thinking like an owner in the best way possible. And my exit strategy, so to speak, is a liquidity event, right? Would be a takeover, or the company gets listed on the main board of the TSX, and now it's a mainstream, well followed name that maybe a Bastion Asset Management can own 5 to 10 years later after my initial investment. It's grown up to be a significant story in the space and potentially become a mine. Those are liquidity events, either a takeover or a major listing where the company is well adopted by the institutional community and there's a lot of liquidity and following and the company's graduated to the next level. So that's my approach. From a commodity basis, I prefer a project that has all the attributes to go all the way than just saying I'm only buying gold stocks. So I own a really interesting zinc investment because I think it's a really exciting tier one opportunity in terms of economics. So I'm not really agnostic as to it has to be gold or has to be copper. There's some commodities I will not touch, like I wouldn't touch lithium a couple of years ago. But if it's in the no, as long as it's not in the no-fly zone for commodities that I will not be buying currently, I'm much more focused on the project. What could it be worth if it succeeds in becoming a buildable mine one day, and where is the valuation today? And as long as my outlook for the commodity is not negative, where I see a major drawdown in the commodity, I'm very open for business. But I have been giving preferential treatment to gold for the last several years. And that could change. If gold hits 15,000 2 years from now, that could change. But right now, I still see quite a bit of opportunity in the space. And it's getting a little harder. I'm not going to lie. And overall, there's more capital available now than it was 6 months ago. So I'm saying no more often to names, but there's still opportunities that have been neglected, underfollowed, capital starved. So I'm still seeing a lot of opportunity, but I expect the harder it gets for me to deploy capital, the better my portfolio will be doing. So there's kind of a hedge trade-off there.
All right, incredibly insightful to hear about this portfolio allocation model that you have. I would love for you to talk about your DD process, your due diligence process, really when you find a potential pitch, how you go through that and what you're looking for to really make a decision on potentially investing or not.
Yeah, I have a checklist. It's not exhaustive. It's sort of the first screen that I look for. And again, these are just hallmarks of what makes a mine and what doesn't. So I'll just go really quickly through it. The combination of grade and scale is very important. So grade is your margin. So what is your kind of margin per ounce going to be? Obviously, the higher the grade, the lower your cost should be, and therefore the higher your profitability should be. So that'll be your kind of cash margin per ounce or per pound, whatever commodity you're producing in. And then scale. So how much of that do you have? So you can have a really high grade deposit that doesn't have enough scale. And so therefore there's not enough available cash flow over the life of mine to fund the infrastructure properly. Or you could have a moderate high grade deposit that has a lot of scale, which would give you the economics to produce that. So I'm always looking for the combination of both those things. And I overlay on the third layer, which is grade, scale, and then infrastructure. This is very, very important. A lot of investors do not give enough credence or analysis to this. If you're in an area where there is no infrastructure, like you're in the middle of Yukon, like Snowline Gold is, or you're in the Andes with 5,000 meters of altitude, there's no roads, no power, nothing. I'm not saying that you're not going to make a lot of money. Snowline Gold is a fantastic discovery, but you've got to find 10 million ounces. You've got to find a heck of a lot of scale and have very good grades. Why? Because on top of building the mine, you got to put the power in, you got to put the roads in, you got to probably have to put a port in and maybe an airport. All those things that cost significant amounts of money, and very rarely do governments fund that check. Once in a while they'll do that, but it's got to be a very strategic area. So usually it's all in the back of the company to fund. So think about it. If your mine costs $1 billion to build, but you've got to put in $2 billion of infrastructure outside of the mine, you just tripled the capital needs of that project. That project has to be extremely compelling geologically. You've got to have a true kind of tier one discovery to justify the overlay of capital needed to build infrastructure. So those are the three kind of capital issues that I talk about, or the combination of those three things. Another thing I look at that investors don't look at that often is, I call it drilling efficiency or capital efficiency with the exploration. So in terms of junior exploration companies, their main business is drilling. So they have to find more ounces of gold, more pounds of copper. So a lot of investors don't do the math on what are my drilling costs per meter. And especially when you're in a situation when you have a very low market cap, but the higher the drill costs are, right, the more dilution you're going to face. To give you an example, let's go back to the Andes or go back to, let's say, northern Yukon. If it costs you $1,000 a meter to drill, but you can drill for $150 a meter in Quebec or say Ireland, where I invest in some of my companies, you're going to get 5 to 6 meters of drilling in Quebec or in a low-cost area for every meter of drilling you get in Yukon. Now, doesn't mean you should just drill because it's cheap, but if you do make a significant discovery, you can expand that resource at 5 to 6 times the pace versus the dilution you're taking on a higher cost area. So again, if I see really high drill costs in an area, I have to see really compelling geology and see incredible attributes on the other 3 things to get me really engaged in that story. So drilling efficiency or capital efficiency with a drill bit is a very important thing, especially when you think like an owner, because I'm taking dilution. Every time we're raising money, we're getting diluted. So think about that when you now analyze your companies. I give a higher grade or score to companies that have a lower cost drilling budget program. The next one would be management ownership. So every management team that ever come in my history, I've seen maybe 10,000 management meetings in my life across all sectors. They always come in and say, we have the best management team, or we're an amazing management team. And sometimes it's true, sometimes it's not. Most people are doing a job, they're doing their honest best. But to me, a good governor of excellent management team in the space is how much stock do they own? How much does their board own? So how much does management and the board own? Because that's a really good differentiator for me of effort. So if you have a management team and board that own 10, 15, 25, 35% of the company, and importantly, they put that money in private placements at prices that are similar to what investors are paying today or what investors could have bought in the open market. They didn't get a bunch of free stock or just penny paper that had been kind of gifted to them. If they're true owners of the business and they've put their own hard-earned cash into the business, it's a really good predictor of behavior that they're going to do everything in their power to make sure that the story is successful. You can't control geology, you can't control cycles often, but you can control thinking like an owner and the effort that goes in. You're going to be up till 2 o'clock in the morning thinking about your business if you own 30% of it versus owning some stock options and a salary. You're just thinking about the next financing and how can I keep my job. Part of my my comment there, but it is true. A lot of companies, they call them lifestyle companies, but really the companies are more interested in preserving their G&A structure than they are about creating value for shareholders. If you don't own equity in your business, you're a manager, and managers care about their paycheck and their bonus. They care less about the equity. So that's a very important thing to me. And if you look at junior mining companies, they may have 2 or 3 full-time employees. If they're lucky, a CEO, a vice president of exploration, maybe a part-time CFO, investor relations person. You have 6 or 7 board members. So if your board owns a lot of stock, and typically the board has a bit more experience sometimes than the management team itself. If the board owns a lot of stock, you're potentially acquiring 6 or 7 more full-time employees that are willing to roll up their sleeves and work. I'm on 6 boards. I get paid basically nothing for any of the boards I'm on, but I spend a lot of hours per month or per year on these companies because I want to grow the value of my equity. So they're basically getting my efforts and the other board members that own a lot of stock for free as sweat equity. And that's extremely valuable in pushing these junior mining companies forward. And then the last one I would say would be you need to have the right balance between economic geologists. So geologists that really understand what an economic discovery looks like and what a science project looks like. So that understand the value of a dollar, understand that drilling is not free, and understand that if they're drilling a project and they don't see the results they're expecting, they have the fortitude and understanding to say, okay, well, our shareholder dollars are precious. I'm going to pivot away from this area, preserve capital, maybe do a bit more work so I understand where to drill next. And so really are focused on making economic discoveries and also understanding that shareholder value is lost through excessive drilling when you don't have a good control understanding of the geology. But at the same time, you don't want a company only being run by geologists. You want a company that's being run by people who understand capital markets. And so who to raise money from, who are good shareholders, who are not so good shareholders, when to raise money, right? How much money to raise, and how to build a really strong and sticky cap table over time is another area where most companies in the space, because they're typically run by geologists, you need good geologists. You don't want me picking drill holes for your projects, but you have to have people understand how do I build a stable quality shareholder register over time that'll give us a good cost of capital that are aligned with our long-term view of creating value. So those attributes, when they all line up with a good project, that's typically when I'll get quite excited. And then I overlay that with valuation. So what am I paying for all that? Where are we in the cycle? What's my entry point? And if I'm right, how much money can I make on a successful execution of that strategy? Understanding that even the work I do, the vast majority of my investments will not become mine. The vast majority of my investments will not go up 20, 30, 50 times. So all I'm doing is trying to put as much of the odds in my favor of de-risking that investment, lowering the risk of initial investment to give me a higher probability of success.
Incredibly insightful there. I hope everyone watching was taking notes. I definitely was. Pulling some threads there, talking about business models for a second. Of course, you were talking about an exploring model a lot. You also have royalty companies, companies that are prospect generators. You have companies that are restarting past producing mines on the cheap. Is that something that you're willing to look at, or is it mostly the explorer model that you're having in your vision?
So I've been really fortunate the last 7-8 years investing in a sector where the pessimism was extremely low and still remains relatively low today in terms of the optimism of the sector being quite muted. There's different stages of risk. The highest risk investment you can make in the sector would be a greenfield exploration story. So one that you've got promising land, maybe some geophysics, some soil samples, but you don't have a proven discovery yet. And so that's the riskiest type of investment you can make in the space. The good fortune that I had was I was coming in the sector when the sentiment was so poor or so negative that I was able to buy projects and still be able to buy projects where existing discoveries are made. You have an existing resource and the project has not been killed from a technical or fundamental basis. There's still potential for it to be a mine, but they've been starved of capital for the last 5 to 7 years. So I've been able to buy projects in that kind of $5 to $30 million market cap, Stijn, where the initial geological risk of, is there a discovery here? Is there something of value on this land package, has already been answered to the affirmative. And so I have really not done much in pure kind of greenfield investing, because typically those type of de-risked investments have $100 million, $150 million market caps in a normally functioning, properly bull market for gold equity. So I've been able to buy a lot of projects without taking a lot of geological risk, higher up on the Lassonde curve, but getting it at a valuation reflective of a very high risk early stage project. As the market starts to mature and as the valuations start to lift for the de-risk projects, we're starting to see that now slowly but surely. It's possible that I go a little farther down the exploration curve to get more torque. But so far I've been able to get really exploration-like torque with much less risk in my portfolio, which is my favorite setup. But I do like all parts of the Lassonde curve, but then generally focusing on between this pre-discovery and sort of say resource delineation into PEA stage is probably where I'm most focused on. You asked about different kinds of investments, royalty companies, different types of investments. I have a preference for 100% ownership of quality projects. So I'm not a big fan of the prospect generator model. Not that it's not a good one, it works for many people. I'm not a big fan at all of joint ventures on my projects. If I have something I think is valuable, I'd rather fund it myself. Sometimes desperate times take desperate measures, but if I owned a 100% owned project and I had no capital, I'd much rather kind of shut the lights off, cut the G&A to almost bare minimum and preserve the capital structure and wait for a better market than do a JV with a Barrick or Newmont and say you can own 80% if you spend $20 million. Because the problem with that is if I'm looking for 20 to 50 times my money and I give 80% of the project away, that 20% better be darn good for me to make 50% of my money, 50 times of my money. So I always encourage my companies preserve, if they don't own 100%, try to get to 100%. And the reason also is when you have a quality project, if you don't own 100%, a lot of the majors will not be interested in acquiring you. They want to have 100% control. So I much rather own 100%. So prospect generators, not really. JVs, I don't like. Royalty companies in general, I have not invested in them. They're great business models, but coming back to my earlier view of what is my view versus the market's view, most market observers really like royalty companies and therefore they trade at relatively high valuations. So it's hard to find disconnected value in the royalty space. You can find some really micro-cap royalty companies who maybe own a royalty on a project that's not well known yet that becomes a really big winner. Like Altius owned a royalty in Nevada and ended up being a huge windfall. So you can find that. They're episodic, but in general, I don't spend too much time on royalty companies either. So it's 100% ownership of assets in the exploration phase, probably to PEA stage projects, which is why I spend the vast majority of my time with my personal capital.
Excellent. And can we talk about jurisdiction for a second, really? Are there jurisdictions that you're not willing to go? Or is that a risk that you're very comfortable taking?
Yeah, in general, I'm comfortable with most jurisdictions, Stijn. I think investors make a mistake as well when it comes to jurisdiction, I didn't cover that in my key points, but jurisdiction is another one I look at quite carefully. But I look at it from a different lens. I look at it as how hard and how quick will it be to get a mine permitted to be built in this jurisdiction. So there's parts of Canada and the US and Australia that have more jurisdictional risk or a worse jurisdiction, some of the worst parts of, say, West Africa or Latin America. So a lot of investors say Canada, Australia, US, good, and Latin America and Africa, bad. So I'm not going to do anything in that geography. If you've ever built a mine or been involved in a company that built a mine, you understand that jurisdiction is hyper-local, right? So it's really the community support at the local level, the state level, and then the federal level. And what are the environmental issues you might have there, the social issues you might have there. So I really look at the project on a one-by-one basis and say, if it ticks all the boxes to potentially become a mine, what are the obstacles socially for it to become a mine? Is there a hostile federal government that is, firmly anti-mining? Is there a taxation policy that makes, even if you build a mine, that 90% of the economics go to the government, there's nothing left for shareholders? Is there local opposition? Even though the federal government might be supportive and the tax laws might be appropriate, is there a small community group there that is vehemently against mining? And so you really have to look at that and understand if the company understands how to navigate those issues as well. But really, it's speed from discovery to production. You definitely get a much faster pathway outside of tier 1 jurisdictions, outside of, let's say, North America and Australia, much faster pathway to production, which you are trading off against inherently more volatility on the social, political, and taxation side. So to me, it's all about risk and reward. It's all about how stable do I view this jurisdiction to be for the next 5 to 10 years? And is there a pathway to production? And I'm willing to pay a little less for a less desirable jurisdiction to take advantage of those faster pathways. So you look at a discounted cash flow model. If you make a discovery today and you're producing in 35 years, the value of that discovery today is very, very low. Even if you're in a great jurisdiction like Canada. If you make a discovery today in West Africa and you can make production 5 years from now, the value of that discovery is actually quite high. So as long as there's not a major roadblock or major red flag that could kind of cause you to lose that asset or get stuck and frozen in path, those less desirable jurisdictions or less thought of jurisdictions are actually quite interesting, especially from an exploration investor perspective, because of the speed of which you can move projects forward. So it's a nuanced answer, but it's really on a case-by-case basis.
Excellent. Really interesting, that case-by-case basis point. You mentioned valuation a bit earlier. How do you know if a junior mining company is trading at an attractive valuation, and how important is that valuation to you before you really make an investment decision?
It's extremely important. I always say investing is a means to an end. So before you invest, what return are you willing to go after? And how much risk are you taking to make that return? It sounds very simplistic, but I often see 75-year-old people, friends of my parents, who are taking crazy amount of risk in the stock market when they're already comfortably have enough money to live the life they want to do. And so they should really be buying, bonds or low risk investments. If you've got enough money to live the life you want to live, and you're later on in your life, why would you take risk to make outsized returns if there's not an immediate benefit from making more money in your portfolio? And so it's the same thing for institutional investors. If you want to make 20 to 50 times your money, you've got to be willing to take a lot more risk, earlier stage companies like I invest in. And you also have to understand that if you're taking that risk in the investment that you make, and you're right, where could that stock trade to? And so what I mean by that is if I'm buying a company that has a significant discovery, maybe pre-resource or just made a resource, first maiden resource, and I say this company looks like this mid-cap producer in North America or Latin America that's trading at a $500 million valuation in the market, and it's got a $20 million market cap today, and it's going to cost me maybe 3 years, maybe $50 to $100 million of capital to get there. What am I going to be when I grow up? What is the next step on the Lassonde curve look like for that valuation of that company? And what am I paying today for it? So I'm always very, very focused on the valuation I'm paying and what this company could look like if it succeeds. And you take other examples in the stock market that are more mature, that are more advanced projects, and it could trade at this valuation of company XYZ in the future. And so that's what I'm always looking at. And then say, okay, is that return big enough for all the risks that I'm taking to think that this company could get there in 4, 5, 6 years? And so that's what I'm always looking at. And so if the valuations lift too high, like they did during the lithium boom, right? You were paying $100 million valuation for a greenfield discovery target potential in lithium because the market was so excited about these stories. They've yet to make a discovery, $100 million valuation for a pre-discovery high quality land package for a lithium story. That same project, if it was a gold project 3-4 years ago, was trading at a $5-10 million valuation. So the same, economic value on a success, the same likelihood or risk of a discovery being made or not, that you're paying 10 to 20 times less for that valuation. So yes, I am very, very focused on the initial valuation and very, very focused on the outlook as to what it could trade at in the future. And that's why my positive tailwind is important, because that $500 million, 100,000 ounce producer per year market cap today was $200 million 2 years ago, right? And so that was why the valuations were very suppressed at the juniors. So you have to understand, where are we on the Lassonde curve? And is the Lassonde curve shifting up or down based on inflows and the macro conversation we had earlier? So yes, it's something I really think about. And being a long-term investor, it's the essential understanding of where it could trade in the future, what am I paying for it now, and is it worthwhile to make that risk-reward trade-off?
Being aware of the time, I would love to squeeze in one or two more questions. Would you have the time for that, Michael?
Absolutely.
Excellent. We could spend an entire podcast just talking about this topic, so apologies for asking this in the end, but warrants, dual-edged sword, can provide a lot of extra upside to a potential investor, but also provide dilution, of course, to the company. Could you talk to us really your vision on warrants, both as an investor and an owner of a business?
Great question, and I want to explain why I'm answering differently to this question as I elaborate on it. So I'd say, as an investor, obviously I really like warrants, because if I like a story enough to buy 5 to 20% of the company, I would be obviously foolish not to seek additional leverage to that upside potential. So if I'm buying a stock at 10 cents or 20 cents, and I think it potential to go to $2, $3 in 3-4 years, and I can buy a 10-cent deal with a 15 or 20 cent warrant, I'd be foolish not to ask for it. So typically when I'm investing in these companies, I do like to ask for warrants. When I'm an owner of the company, I often tell companies, be careful about issuing warrants. And I'm not being hypocritical here. I'll explain why I'm saying that, is that warrants are a great tool if you're issuing shares to the right type of investors. So if you're myself and you're coming in with a 5 to 20% investment and you're filing as an insider and you never sell and you support the company on subsequent private placements, you're not trying to clip the warrant. The danger in issuing warrants for companies is if you just do a brokered deal, you say, I'm desperate to raise money and I'm going to issue a share at 10 cents with a full warrant, 15, 20 cents for 3 years. What you're going to attract in your financing, if you're not careful, is a bunch of shareholders who don't care about the company at all, that'll buy the deal. And as soon as the 4-month hold is off, or even worse, it's a life deal, as soon as the ink is dry on the contract, they're selling their shares on the market, hanging on to the warrant as a free call option, and saying, well, if this company makes a discovery, the stock will go up huge. If it doesn't, I've already took all my money off the table, so I've got a free call option on exploration success. But what that does to the company is, you raise $5 million on Monday, the stock's free trading on Wednesday, you've got $5 million for sale in the open market of all those shareholders that are just clipping the warrants and recycling the stock back in the market. So when I make a financing offer to a company, I say, yes, typically I require a warrant. I'm not going to sell my shares. I'm highly likely, if you succeed and do well, to exercise my warrants early. So if you give me a 2 or 3 year warrant and the stock is 50 cents in 6 months from now, instead of doing another private placement, I'll exercise my warrant, provide additional cash to the company, avoid doing another financing. And before I invest in a warrant deal, I want to know every name in the book. If they're raising $5 million, I want to know who are the other investors coming alongside me, and making sure that they're all aligned with me in terms of being long-term sticky shareholders that want to be owners for multiple years and not warrant clippers. So one of the advice I really add a lot of value when I'm involved in a company is on financings. Because I know the players in the market. I know who are higher quality shareholders. I know who are lower quality shareholders, who are really bad shareholders for the company. And I think over the last 7-8 years, I've been able to keep a lot of my companies out of trouble. Because when you need money and you're an explorer and you're not really aware of the dynamics of the stock market, you go, oh, it's great. I'm offered $5 million. It's fantastic. And you say, why is my stock trading like garbage for the next year and a half? You don't realize those shares are selling constantly in the market. So warrants are a means to an end. If you can do financings without warrants, even better. If you want to issue warrants as an issuer, please make sure who you're issuing those shares to and be wary. But they can be helpful to attract the right kind of investors on the right terms over the long term.
And Michael, especially for European viewers watching, you're going to be in Europe soon and they might have an opportunity to meet you in person. Can you talk about what that's all about?
Yes, I'll be in Europe from October 6th to 10th. I'm doing a 5-city roadshow. We'll be having a conversation along these lines where I'll be talking about my allocation approach to junior equities, what I look for in junior mining investments. What's different, that's not this interview, instead of being, one, it's going to be live. But two, I'm a big believer in sharing what I do in the junior mining space and try to share my knowledge and my approach. But I'm bringing 6 of my mining companies with me, 6 of my largest investments with me on the road. So you'll hear my theory and then hopefully be able to compare it to the investments I've made, and I'll give you a really comprehensive view of how I try to invest in the junior mining sector. They also happen to be 6 of my largest investments and companies that have really ticked a lot of the boxes. You'll be able to see in real time the attributes of a quality asset and a quality management team. I'll be in London, October 6th, Paris, October 7th, Geneva, October 8th, Zurich, October 9th, and Frankfurt, October 10th. Hopefully you can add the link to the show notes for registration. It's a free event for investors that are interested and passionate about investing in the junior mining sector. Great opportunity to meet people face to face. Haven't had a chance to do that a lot the last 5-6 years with COVID and family purposes. But it'll be a great opportunity to meet. There'll be one-on-ones and opportunities to meet companies privately if you want to meet, and there'll be a group lunch in every city where we'll have that formal presentation of myself and the 6 companies together.
Michael, thank you so much for your generosity with your knowledge and your time today. I tremendously appreciate it.
My pleasure. Always fun.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.